Most shareholder letters are, well, they're pretty dry, formal documents, right? But not when they're from Warren Buffett. His 1998 letter to Berkshire Hathaway shareholders is so much more than a financial report. Honestly, it's a treasure trove of timeless wisdom on how to think about business, value, and management. And it all starts with a number that looks almost too good to be true. I mean, just look at this number, 48.3%. On the surface, 1998 looked like an absolutely spectacular year for Berkshire Hathaway. That's how much the company's book value per share went up. Any other CEO on the planet would be doing backflips and shouting that from the rooftops. But we're talking about Warren Buffett, and his immediate reaction was to basically pour cold water all over this incredible headline number. So why? Why would he do that? Well, because as he wrote, that 48.3% gain was not as good as it looks. And if you can understand that one little distinction, you're on your way to understanding how he thinks about value. So Buffett uses this moment to teach us a really crucial lesson about the difference between accounting numbers and actual economic reality. It's all about figuring out what a business is truly worth, not just what the spreadsheet says it's worth. Okay, so first up is book value. The simplest way to think about this is it's the company's net worth on paper. It's a formal accounting number you get when you take everything the company owns, its assets, and subtract everything it owes, its liabilities. But then there's intrinsic value, and this is the big one. This isn't some number an accountant comes up with. It's an estimate of the true economic worth of a business. It's all the cash that business can be expected to produce for its owners from today until the end of time. This is the number Buffett and Charlie Munger really care about. So here's the difference in a nutshell. That incredible 48.3% gain in book value, it mostly came from Berkshire using its own highly valued stock to buy other companies. So it was kind of an accounting illusion, not a real increase in the company's earning power. And that's the key. Buffett cares about what the business is actually worth, not just what the books say it's worth.
All right, so if the accounting numbers don't tell the whole story, what is the real economic engine driving Berkshire? To get that, we have to talk about one of Buffett's favorite concepts. He calls it the magic of insurance float. So what on earth is float? Well, think about it. It's all the money that insurance companies collect from you in premiums that they get to hold on to and invest before they have to pay it out in claims. In Buffett's own words, it's money we hold but don't own. It's just this massive, massive pool of capital.
And when I say massive, I mean it. Just look at the scale of this thing. Berkshire's float grew from just $17 million back in 1967 to almost $23 billion, with a B, by the end of 1998. That is just a staggering amount of other people's money that you get to invest for yourself.
But here is the truly magical part, the cost. See, usually there's a cost to using money. For an insurer, if they pay out more in claims than they collect in premiums, that's a loss. But Berkshire, over the long haul, has been so good at this that they've consistently run an underwriting profit. What does that mean? It means they have actually been paid to hold on to this huge, growing pile of cash. It's better than free money. Now, having that kind of financial firepower lets Buffett follow a really unique management philosophy. He doesn't micromanage. He doesn't tell his CEOs what to do. Nope. Instead, he just creates an environment where great managers can do what they do best. He gives them this incredibly simple but powerful three-part mission. This isn't about hitting your quarterly numbers to make Wall Street happy. This is about creating an extreme long-term mindset and a real, genuine sense of ownership. The story of Geico is the perfect example of this in action. Most public companies would be terrified to spend so much money on marketing that it crushes their short-term profits. But Berkshire isn't most companies. They knew that every single dollar they spent getting a new Geico customer would create way, way more than $1 of value in the long run. And boy, did they put their money where their mouth was. Just look at that marketing budget explode. They were completely free from that tyranny of short-term expectations from Wall Street. And that allowed them to build a competitive fortress that would last for decades. This freedom from thinking in 3-month chunks also leads us to my favorite part of the letter. This is where Buffett really takes the gloves off. He declares all-out war on what he sarcastically calls bold, imaginative accounting. His first target was stock options. See, back in 1998, companies didn't have to count stock options as an expense, which Buffett thought was just insane. And he cuts right through all the financial jargon with these simple, devastating questions. He basically exposed the truth. Options are a very real cost to shareholders, and they should be treated like one.
He uses that same sharp logic to go after another accounting trick, the restructuring charge. He compares it to a cheating golfer. Imagine you go out and shoot a terrible first round, like a 140. You just call that a restructuring of your golf swing. Then, for the rest of the season, you only count your good scores. You pretend all the bad holes are just part of that initial charge. Your scorecard looks amazing, but it's a total fantasy.
And here's the real point he's making. It's about the ethical decay this stuff creates. When companies start playing games with their numbers just to please Wall Street, a dangerous everybody's doing it attitude takes hold. And as Buffett warns, that's exactly how bad accounting drives out the good.
So you can see how all these ideas, thinking about intrinsic value, building an engine like float, trusting your managers, and demanding honest numbers, they all tie back to one central theme. It's the final and maybe the most important lesson of the entire letter.
And he delivers this lesson with just stunning humility. He openly admits to his shareholders, his partners, that selling McDonald's stock was a huge mistake. He says they would have been better off if he'd just gone to the movies instead of selling. I mean, can you imagine another CEO saying that? It's that level of total transparency that builds unbreakable trust.
So, when you put it all together, what are the core principles from this masterclass? First, focus on what a business is actually worth. Its intrinsic value, not just what the accounting says. Build a powerful financial engine, like float. Trust great managers, and give them room to run for the long haul. Demand honesty and transparency in the numbers. And finally, always communicate with your owners like they're true partners. And that really brings us to the final thought. This letter was written more than 20 years ago, but the lessons feel more urgent today than they ever have. In a world that's obsessed with quarterly results and financial engineering, it leaves us with a question. Is it possible that this simple, patient, and profoundly honest way of thinking about business isn't old-fashioned at all, but is actually more relevant than ever?